Good morning, everyone. Welcome to our channel. So, in this video, we are going to see marginal costing. So, what is meant by marginal costing and formulas of marginal costing we are going to see. So, first, what is mean by marginal costing? So, marginal costing is what is mean by first marginal cost. So, marginal cost means your variable cost. So, another name of variable cost is called marginal costing. That is, if 1 unit of output is increasing, so for a change of if 1 unit of output changes, so how much the cost is changing? So, that is called the variable cost. So, how much cost is changing? So, ascertaining this on technique. So, that is called marginal costing. Is called marginal costing. That means if I am producing, example, I am producing, uh, say for example, 200 units of pen. So here I have incurred like material, labor, so everything. So for example, material 5 rupees, labor is 2 rupees. So if I am producing 100 units, if I am producing 100 units, the same material per unit will be same, labor per unit will be same, but total will change. That is, for 200 units, I am incurring 5 into 200. That is 1000 rupees of material, 5 into, sorry, 2 into 200. That means 400 rupees of labor I will be incurring. If I'm producing 100 units of pen, so my material cost will be 5 into 100, that is 500. So here my units is reduced, so my cost is also reduced. So this is called marginal cost. So labor, what about labor? Labor we will be incurring 2 into 100. That means 200 we will be incurring. So this is called marginal costing. So for a change in units, there is a change in cost as well. So for decision making purposes, we are considering only variable cost because if I am paying rent, whether I'm accepting that the order or not, I have to pay the rent. So here, fixed cost is not relevant for decision making. So here I am treating in margin costing the relevant cost for decision making is my variable cost. Fixed cost is considered only when it is changed. If it pertains to that decision. So, say for example, I want to incur additional expenditure of 5,000 rupees for accepting the order, like design charges. So then in that case, I want to incur that 5,000. So I want to consider, or else I won't consider fixed costs. So here in margin costing, the total cost is broken. The total cost we are dividing into fixed cost and variable cost. So fixed is it won't change irrespective of my unit. So it is fixed. That is called fixed. And say for example, if I am paying rent for say for example 1,000 rupees. So even if I am producing 100 units, rent will be 1,000, or 500 units also rent will be 1,000 rupees only. So this is called fixed cost. So fixed cost in total remains constant. Per unit will change. What it means? That is for 500 rupees, I'm producing 100 units. Then in this case, 500 divided by 100. So that means 5 rupees per unit. So in this case, if I'm producing 500 units, that means 1000 rupees divided by 500. So that means 2 rupees per unit, right? So fixed cost per unit will change, but in total remains constant. Whereas variable cost in total will change. Per unit is constant. So like how we are using material 5 rupees per unit in 100 units as well in my above example. So for 200 units also, I'm using the same material as 5 rupees per unit. So now I am considering sales minus variable cost. Here I am using a new term called contribution. So that means contribution is equal to sales minus variable cost. So I'm here again, I'm reducing my fixed cost. So I will be getting my profit. So here my contribution will be sales minus variable cost, or if I want to give reverse working, then it will be C minus F is equal to profit, right? That is contribution minus fixed cost is equal to profit. So then in this case, if I'm bringing this F this side, so F plus P will be is equal to contribution. So I can say contribution is equal to sales minus variable cost, or contribution is equal to fixed cost plus profit. So either way, I can use this formula. So here I am bringing a new term called profit volume ratio. That is PV ratio. In short, we will be saying PV ratio, contribution to sales ratio. So whatever we can say, that means this is a relationship between profit and your sales. So relationship between contribution to sales. So here the formula is contribution divided by sales into 100. So I'm using here 100. So the resultant will be percentage. So if I'm not using 100, it will be in fractions. So always PV ratio is measured on sales percentage only. So PV ratio is based on sales only. That means, example, a PV is said to be 40%. That means on sales, it is 40%. So sales will be the base. Sales base, that is 100%. So PV is, that is contribution ratio is 40%. So the remaining 100 minus 40. So I will be getting 60. 60 is my variable cost in this scenario. That is sales minus PV is equal to variable cost. So 60% will be my variable cost. So say for example, my sales is 50,000. My PV is 40%. So my variable cost, that is 50,000 into 60%. So I will be getting 30,000 as my variable cost. So this variable cost 60% is also said to be variable cost ratio. If variable cost is 70%, say for example, and my sales is 1 lakh, then my PV ratio will be 1 lakh into 30%. How I'm getting this 30%? That is 100 minus 70, that is 30%. So I will be getting 30,000 as contribution. So till now we have covered variable cost. Now I am going to see break-even sales. So what does mean by break-even sales? So break-even point or break-even sales. So that is BEP. So that means no profit, no loss point. That means my sales will be equal to my total cost. So if I want to say in equation, my sales will be equal to total cost. So if I want to say in formula wise, so break even point, I want in units, say for example, if I want in units, my formula will be fixed cost divided by contribution per unit. See, always, whenever I want the answer in units, I will be using contribution per unit. Okay. So then the resulting answer will be in units. If I want break-even points in rupees, then I should use the formula for fixed cost divided by, instead of contribution, I will be using PV ratio. So now I'm expanding this PV ratio. That is, what is PV ratio? Fixed cost divided by contribution by sales, right? So if PV ratio, if I'm getting PV in decimal, so F into S by C, I can use this formula as well. So, or F into S, what is mean by C? S minus V. So either way, I can use the same formula. So this will be used in case of PV is in decimals. That is, if I'm getting an answer called 33.3333, so this is going on, right? So in this case, if I'm using this formula, I will be getting fixed cost and total value, that is BP in exact value I will be getting. So, okay, if I have BP in units, I can multiply it by selling price per unit. Okay, selling price per unit. Then I will be getting BEP in rupees. Same way. So BEP in rupees divided by selling price per unit. So this will be amount to BEP in units. So if I have two periods, so if I have two periods, then PV ratio is change in profit divided by change in sales into 100. Then we have margin of safety. So margin of safety, that is MOS. So this is actual sales minus break-even sales. That means how much safety, how much safe my business is. So for this only, I'm using this formula. So that is how much I'm earning after meeting break-even sales. So this is the formula. So if another formula we have is profit divided by PV ratio. So if I required margin of safety in percentage, that means actual sales minus break-even sales divided by your actual sales into 100. So you will be getting in percentage. So again, this is mentioned in sales only. So base is sales. That means if margin of safety is 60 percentage, my sales will be 100 percentage. Then my break even sales will be 40 percentage. That is 100 minus 60. So 40 percentage I will be getting. So and then again I have another formula here. So required sales. So how I want to calculate how much sales I require to obtain. That is required sales is equal to fixed cost plus profit divided by PV ratio. So this will result in rupees. So if I want, if again, PV ratio is in fraction, that is, if PV is not exact, that is 33.33 percentage. So I can use fixed cost plus profit into sales by contribution. So in this case, I can use this. That is here I'm referring as selling price per unit and divided by contribution per unit. So and if I want required sales in units, then my formula will be fixed cost plus profit, that is desired profit. So here also desired profit. So how much profit I required? So that one I want to use divided by contribution per unit. So I will be getting the answer in units. So always remember, if I'm using contribution per unit, I will be getting the answer in units. If I'm using PV ratio, I will be getting the answer in rupees. So then, if I want to calculate how much profit I want to earn, then required profit is equal to desired sales into PV ratio minus fixed cost. So here I have another concept called cash break-even point. So in break-even point, we are using total fixed cost, that is inclusive of non-cash items also. So if I want to calculate the cash break-even point, in this case, I want to use cash fixed cost divided by PV ratio. That means fixed cost is, say for example, 70 lakhs, including depreciation of 30 lakhs. Then in this case, depreciation is non-cash item, right? So I want to remove depreciation. So here cash fixed cost will be 70 lakhs minus 30 lakhs. That means 40 lakhs only I should consider as fixed cost. So if PV ratio is, say for example, 40 percentage, then my cash break-even point will be 40 lakhs divided by 40 percentage. That means 1 crore will be my cash break-even point. Then we have a concept called shutdown sales. That is shutdown break-even point. So that means even if I'm closing down the business, some fixed expenses won't reduce. So in that case, fixed cost minus shutdown cost divided by PV ratio will be my formula. So here we have one more concept called key factor analysis. That means scarcity. So key factor means scarcity factor. Say for example, if raw material availability is limited, then in this case, I want to calculate contribution per kg of raw material, which means contribution per unit divided by raw materials required per unit. If direct labor hours availability is limited, then calculate contribution per labor hour. That means contribution per unit divided by direct labor hour required for 1 unit. Say for example, if direct labor hour required to produce 1 unit of output, 2 hours. So my contribution here is 20 rupees. Then 20 divided by 2, that is 10 rupees per labor hour. This is called contribution per labor hour. So I want to rank based on highest contribution. if machine has is limiting factor, calculate contribution per machine hour. That is contribution per unit divided by number of machine hours required for 1 unit. So ranking is based on, so for all these cases, ranking should be based on highest to lowest. Then I can allocate the resources. So if I want to close down a business, then if I want to close down or shut down a division, when I can do this contribution only in case of contribution is negative. So even if I am even if I am having a rupee, 1 rupee of contribution, the division can be continued. Then to accept order, the extra order, I want to calculate the price based on variable cost. So calculate the minimum selling price based on variable cost plus additional profit required in this case plus my additional fixed cost if any. So to make or buy, that is either I want to make a product by either I can buy a product or I can make by own. So in this case, I want to consider or calculate savings. So if the savings is more, I can buy the product. That means here making cost, savings is equal to making cost that pertains to variable, okay, minus my purchase cost. This will be my savings. So I guess I have covered all the formulas related to margin costing. So hope you find this video is very useful. So please subscribe my channel and hit your bell icon. Thanks for watching.